Welcome back to the deep dive. You know, our goal here isn't ever just to skim the surface of corporate filings. We really like to dig in, past the raw numbers, past the glossy presentations, to find the real story, what's actually driving strategy and innovation. Today, we're taking a close look at a major global healthcare company, analyzing their third quarter 2025 performance. We want to test their own narrative. You heard the CEO, Robert B. Ford, talk about consistent, high-quality performance and this differentiated product pipeline leading to durable long-term value. So our mission is to find the specific tech, the specific financial moves that actually back that up for you. Okay, first glance, the Q3 2025 snapshot. Worldwide sales hit $11.4 billion. That's 6.9% reported growth. Adjusted diluted earnings per share, $1.30. Solid numbers on the surface, yeah. But while anyone tracking this industry knows the real story is often buried a bit deeper, especially in how they define their core health.
Exactly. I mean, with any company that had a big chunk of revenue tied to the pandemic, you absolutely have to look beyond just the reported sales figures. If you don't really get into those adjusted metrics, you could easily misinterpret what's happening, especially with diagnostics normalizing. So the metric management keeps pointing to, and the one you really need to focus on, is organic sales growth, excluding COVID-19 testing sales.
Right, that's the big adjustment. It pulls out the wild swings from the pandemic peak. It accounts for foreign exchange effects, and it even takes out things like discontinued product lines, like those Zone Perfecta bars they stopped selling in nutrition. So they're trying to show the underlying pulse, the ongoing business.
Precisely. That's the idea. And using that very specific adjusted metric, what they call the core underlying performance, the company-wide growth in Q3 was actually 7.5%. That's the number they feel really represents the business going forward, as we're in this endemic phase. And what's really telling is they held firm on their outlook. They reaffirmed the full year 2025 guidance for that same core metric, 7.5% to 8.0% growth.
That confidence is definitely interesting. But it has to come from somewhere specific, right? It can't just be floating there. When you break down the four main businesses, nutrition, diagnostics, established pharma, and medical devices, it becomes pretty clear where the heavy lifting is happening.
Oh, absolutely. It's all about medical devices right now.
Yeah.
No question. When you look at that overall 7.5% core growth, the medical devices division is really carrying the load. It delivered a huge 12.5% organic growth in Q3. That generated $5.4 billion in sales just from devices. So this is where that differentiated product pipeline they talk about is really turning into actual revenue.
Okay, 12.5% organic growth in medical devices. That's huge. And digging into the details, it was striking how concentrated that success was. You mentioned 5 specific areas hitting double-digit growth: diabetes care, electrophysiology, and, well, maybe the most fascinating one, structural. Yeah, structural heart. If you're watching the healthcare space, or maybe you're a competitor, that seems to be where a lot of the action is. We're talking fixing heart valves without cracking the chest open. So what are the key innovations really pushing that segment forward?
Well, the first one, and probably the most strategically significant right now, is the Navitor TAVI-VIS. TAVI, that stands for transcatheter aortic valve implantation. Basically, it's a minimally invasive way to replace a diseased aortic valve using a catheter.
TAVI. Okay. Big technical term. For those of us not in cardiac surgery, can you just contrast that quickly?
Yeah.
How's it different from the old way, and why is that difference such a big deal for growth?
It's a world of difference, mainly in cost and recovery. Traditional valve replacement. That involves, open heart surgery, splitting the sternum, stopping the heart, weeks, maybe months of tough recovery. TDI, though, you insert the new valve through a catheter, usually just a small cut in the leg, often done with the patient awake under sedation. They go home much faster. And the really interesting part here, the thing driving the Q3 buzz, is the expanded approval they got, the CE mark approval back in August.
Okay, what was the expansion? Because patient volume, market size, that's where the money is.
Yeah, so previously TDI was often seen as something for high-risk patients, people who just might not survive the traditional open surgery. But this expanded approval means Navitor can now be used to treat people with symptomatic severe aortic stenosis who are considered at low or intermediate risk for open heart surgery.
Whoa, hang on, let me process the shift there. You're taking something that was a major operation, huge hospital cost, intensive care, mainly for the very sickest, and you're moving it into a catheter lab procedure for people who are actually healthier.
Yes, exactly. It's a game changer for treatment protocols. By opening it up to low and intermediate risk patients, they massively expand the potential patient pool. It just speeds up the whole trend towards less invasive options becoming the standard, even for people who aren't quite as sick.
Yeah.
That's where the real long-term value gets created, reducing the burden on patients and the healthcare system.
That implication is, well, it's pretty staggering. What's the second big innovation you mentioned in structural heart?
That would be the TriClip system. It just got regulatory approval in Japan back in July. So while Divider deals with the aortic valve, TriClip is designed for something called tricuspid regurgitation.
Tricuspid regurgitation. Sounds serious. What does that actually mean for a patient?
It means the valve on the right side of their heart is leaky, letting blood flow backward. It causes really debilitating symptoms, severe swelling, fatigue, trouble breathing. And historically, it's been very tough to treat surgically. Often, surgery was only an option for the most desperate cases because the risk was so high. TriClip is basically the first minimally invasive option for this. It's delivered via catheter, again avoiding open heart surgery. It's not just a device, it's potentially a huge quality of life improvement for a group of patients who didn't have great options before. And this focus on structural heart repair is getting nods from the outside too. There were new treatment guidelines presented at the European Society of Cardiology Congress in August. These guidelines basically gave more support for using both TriClip and their other successful device, MitraClip, based on a bunch of clinical studies. So the medical community is really getting behind this less invasive approach.
And before we completely leave medical devices, we should probably touch on the sheer size of their diabetes care business. Those continuous glucose monitors, CGMs, they're just pulling in massive sales, $2.0 billion just in Q3, growing 17.2% organically. It really shows the breadth of their device strength beyond just the heart valves.
Right, and that kind of blockbuster performance in devices helps put the other segments into perspective, especially those facing, let's say, structural headwinds. Diagnostics is the prime example here. It's dealing with that sharp but frankly expected normalization after the pandemic peak.
Yeah, looking at the reported numbers, diagnostic sales actually decreased by 6.6% in Q3, which looks bad at first glance, until you remember they booked something like $265 million in COVID testing sales this time last year, and that dropped to just $69 million this quarter. Huge difference.
Exactly. So once you pull out that COVID testing decline, which is really just the market finding its new level, the underlying diagnostics business eked out 0.4% core organic growth.
Wait, 0.4%? That's barely growing at all, isn't it? If medical devices are roaring ahead at 12.5% and you take out the COVID factor, diagnostics seems almost flat. Are we sure that's just stabilization, or is that maybe a bit of stagnation hiding behind the device success?
That's a really important question. It suggests things have stabilized, yeah, but it also points to some very specific geographic issues. Routine testing volumes are recovering, sure. But the core laboratory diagnostics part that grew only 2.2% organically was definitely held back by what they called challenging market conditions in China.
Okay, China. Can you unpack that a bit? What's making the diagnostics market tough there right now?
The main thing is a policy called volume-based procurement, or VBP. You hear about this a lot now. Basically, the government runs these big competitive bids for high-volume medical supplies, including diagnostic tests and the chemicals they use. It forces prices way, way down. If you win the bid, great, you get the volume, but your profit margin gets squeezed significantly. It makes it really hard to post strong growth in those high-volume areas. So that 0.4% core growth, it reflects not just the post-COVID normalization, but also trying to operate under those intense pricing pressures. Okay, moving quickly to nutrition. Organic growth there was 4.0%. Not bad. The real engine within nutrition was adult nutrition that saw 5.4% organic growth, mostly driven by their big brands, Ensure and Glucerna. And like you said earlier, they're strategically pruning the portfolio, getting rid of things like the Zone Perfect line. That's why it's excluded from that core growth metric. They're focusing on the higher margin and more medical-type nutrition products.
Got it. And the last piece, established pharmaceuticals, that's their branded generics business, right?
Yeah.
$1.5 billion in sales. There's 7.1% organic growth there. Seems like a very geographic story. It really highlights a smart strategy targeting specific regions.
Exactly. That growth was overwhelmingly fueled by what they call key emerging markets, KEM. Those markets delivered an impressive 11.1% organic growth. And that wasn't broad. It was really concentrated. Double-digit growth in several specific countries across Asia, Latin America, and the Middle East. It shows they're successfully leveraging established, trusted brands where generics might not have the same pull as in, say, the US or Western Europe.
So it's interesting when you step back, you see this diversification strategy really working. You've got this extraordinary growth in medical devices, especially structural heart, and then this very targeted, strong growth in emerging market pharmaceuticals. And those two things together are basically acting as the buffer, the shock absorber,
That's a good way to put it.
allowing the company to still hit that overall 7.5% core growth target, even with that huge drop-off in the high-margin COVID diagnostics money. It seems like a pretty robust portfolio performance overall.
It really does demonstrate the value of having strength across different areas that are subject to different market cycles and pressures.
And beyond the P&L, there was one detail that jumped out, showing their wider footprint in just, well, basic healthcare infrastructure. Their effort around the blood supply shortage in the U.S.
Yes, the Big Ten collaboration.
Right. Our sources mentioned blood is needed every 2 seconds here, and some blood centers literally have less than a day's supply sometimes. So the company, and this is the staggering part, they screen over half the world's blood supply. They teamed up with the Big Ten universities for a big blood donation drive.
That's a fascinating detail, isn't it? It really underscores the sheer scale of their role in global public health infrastructure when you realize they screen 50% of the world's blood. Wow. It reminds you how essential their core diagnostics business is, even with those VBP pressures in places like China. It's that kind of background infrastructure that just keeps modern medicine functioning. And speaking of reliability, maybe let's wrap up the financial side with a quick note on stability, especially for anyone looking long term. The company declared its 407th consecutive quarterly dividend. It's 79 per share. And they're part of that S&P 500 Dividend Aristocrats Index. They've increased their dividend payout for 53 years straight. That kind of long-term financial consistency really underpins the CEO's claim about creating durable value, even as the individual business segments shift and evolve underneath.
Okay, so let's tie it back to that initial CEO statement. The evidence really does seem to support it. That powerful, minimally invasive structural heart pipeline, Navitor, TriClip, plus the sheer scale of diabetes care, those are clearly the main engines right now. They are successfully offsetting the predictable cooling of the diagnostics business post-COVID and navigating those pricing pressures overseas. But all right, here's the final thought we want to leave you with, something to really chew on. Since that Navitor TAVI system is now approved for lower and intermediate risk patients, what does that mean long term? Socially, economically. Think about it. Non-surgical options becoming the go-to treatment for people who are progressively less sick. This could fundamentally change how we even define severe heart disease, right? It could reshape costs, recovery pathways, quality of life expectations for whole healthcare systems. What really happens when the operating room gets replaced by the cath lab for more and more heart repairs? That's the future they're building towards. Thanks for diving up with us today. We'll catch you next time.